Let's say the price and rent forecasting models that we've developed that we won awards for. There's some scenario, just that. Let's just talk about that piece of technology for a moment. Sometimes that says this place is going to go up and to the right. But we then do fundamental analysis and we say, you know what, that's one data point, but let's look at all of the other stuff and let's decide whether or not we actually have an opposing opinion to it. And sometimes we do, and that's actually a really important part of it. So sometimes even with all of our technology, we'll have certain parts of our technology, like maybe our predictive model, we'll be like, oh, this location looks like it's going to be flat. But then we look at everything else and we go, no, it's not. Right. And so having that ability to kind of weed through that is really the most important thing. Hello and welcome. You're listening to Dashdot Insider, the auditory epicenter for passionate property investors seeking a life of freedom, choice, and abundance. And it feels good to do that intro again after a little while. Emil, you're the host. How are you?
I'm very well, Goose. Yourself?
Very well. Thanks for letting me stretch my legs on the intro there. I appreciate the opportunity.
I think a lot of people listening will be happy to hear your voice again. We do get a lot of requests saying, when's Goose coming? We do actually get them in socials and things like that, and some of the comments. It's like, when's Goose coming back on the podcast? We have had those comments,
it's an interesting one, isn't it? And I think I've spoken about this before. Like as the company has grown, the ability to leverage my focus on really big strategic moves that are going to create really momentum shifting change for our clients and for property investors generally is really, really important. But I also, what's important to me is I actually don't want to be anyone's guru, and so what I think is really important is that people understand that, Dashdot now is a team of, about 100 people across the whole spectrum. And we've got the highest density of intelligence and talent in the entire industry. And I think it would be misrepresentative of me to try and, to hog that limelight. I think we've got so much talent in here. Like Sean, our head of property.
Yes.
Thank you.
The big boost I gave Sean when we recorded one a couple of weeks ago was...
Is that he's smarter than me? Yeah, I know.
That, and also of everyone in Australia, I cannot imagine that there is another person alive who has investigated and looked at more properties for sale over the course of the last 2-3 years.
Well, that's
potentially an unhealthy amount. Potentially unhealthy. It's an interesting thing to think about. I don't know that anyone would have done that many properties, which is slightly concerning, but that's all good.
Yeah.
Well, the main topic that we want to rip into today, now that we've got Sean, our head of property, and Goose on the podcast, is the property market has fundamentally changed. And so that's what we want to look into. And I guess you've got a few ideas on that, Goose.
Yeah, I think it's really important that people start to get a handle on this because, like property investing today is different to property investing 5 years ago, is different to property investing 10 years ago, is different to property investing 50 years ago. So much has changed, not just about how the market moves, but also how we engage with the market has fundamentally changed. So I was reflecting on when we very first started Dashdot just over 5 years ago now. At that time, we were introducing the concept of borderless investing. Property, and this might seem bizarre today to anyone listening to this, but 5 years ago, it was not common for property investors to invest interstate. That was really not common. And we had to introduce this topic, this idea of borderless investing. Did you know that you can find the best locations outside of your own backyard? And that was a big education piece we had to go on. And I'm not going to sit here and say we single-handedly, changed that narrative in the market, but that was a real big thing that we had to try and educate people on that it was possible. Now,
just to second that, even on the ground, every single area we went into when you were speaking to agents on the ground every day, they had no idea of the concept of what we were trying to do or achieve. They were like, are you trying to pinch my commissions? Like, how does this work? What do we do? Like, it was so much confusion, and we had to really sort of pave the way in all these markets, which now it's, I think they'd sell a large portion of all their stock to buyers agents. So it's a very, very familiar term now.
Totally, yeah. Even the term buyers agents when we started was a market education opportunity, right? And so if you just go back a little bit, like let's go say back to the year 2000, the whole idea of being able to, like technically able, not just willing, but technically able to buy a property interstate was like almost impossible, right? Because, the access to the information, access to data didn't exist. How would you find the right location? You would probably have to go there and do an inspection. How would you build up the networks? Go back a little bit further when it was landlines. Go back a little bit further before there was internet, right? So all of these things get harder and they were harder and they've gotten easier and easier and easier over time through access to information. Now, over the last 5 years, the dynamics of the Australian property market have significantly changed because of an evolution in how property investors are engaging with the market. So, for example, a greater willingness to invest in a more borderless context, a greater expansion of companies like ours who are helping investors to invest in that way, but also access to information. So, back when we very first started, the idea of like finding a hotspot, it was like, there's 15,000 at the time. There was 15,263 towns and suburbs in Australia. That's now slightly higher because a few new towns have been categorised by the census. But there was this idea that there was this whole blind spot of places, and you got to go and find, or like almost like I'm going to go out and hunt for a new place that no one else knows about, right? To invest in, which is a pretty wild concept. Now, over time, particularly as we have developed the technology and tools to see deeper into the market, there's no new places, right? So this is the first thing we've got to understand is there's no new places. We've sort of found them all, and the information exists, and we've brought that up to the surface. So what that has done has changed the way that markets move. And I'm not saying that singularly Dashdot has changed the way markets move. The way the market has evolved is changing the dynamics of how markets move. And I know, Sean, you've got some points of view on that, and I want to throw to you in a second because I think you've got some really interesting ideas on how that kind of like the investment movement dynamic has shifted in the markets. But the other point that I want to make is that because of the access to information, and because in effect what has happened over the last few years is we collectively as an industry have exposed all of the places, right? So now there's no like hidden suburbs. There's some places that are investable and some places that are not currently investable, right? That's broadly it. None of them are hidden, so to speak, right? What's also happened is we've had a convergence of macroeconomic factors which are in effect causing a perpetual bid type scenario for the property market, which basically means that the property market as a whole is under a tremendous force to overall grow. And so rather than say there's 15,363 towns and suburbs in Australia and only the top 1% of them are going to grow and the rest of them are all dead, which is in fact what you actually see if you look at the S&P 500, it's only the top 7 companies or the top 5% of companies that move the entire S&P 500. The rest of the companies are just basically dead. There's a situation where you have a significant asymmetry as it relates to growth and returns. If you just pick the top 5%, you'd probably be fine, right? What's happening now in Australia is broadly there's more pressure for markets generally to move. Why? Influx of capital. There's an extremely high amount of liquidity floating around in the market. The RBA in their latest rates meeting basically said, because the government keeps spending too much money, we can't lower rates. So there's so much liquidity sloshing around, it's unbelievable. We have record immigration. We don't have enough houses. The list goes on, and we've talked about it all before. This is causing a situation where there's an inherently large amount of pressure propping up broadly the Australian market, broadly. And so what it comes down to now is not necessarily trying to find locations that were, once upon a time, we would try and find locations that had a long period of stagnation and had not grown. We would then identify the optimal entry point to get in before it had started growing. Then we would invest in that location, then it would grow. Now, if we take a baseline there and said, well, broadly, markets are growing, broadly, the opportunity to find these kind of like hidden flat spots is somewhat subdued. And also, we don't necessarily need to do that, by the way. And so we can start to take a different view on how to find those optimal entry points based on what we can kind of see in fundamental analysis. Before I keep waffling on, Sean, I'd love to get your point of view on how that kind of like market movement dynamic has changed.
Yeah, just probably the first thing I'd say is not only is the market fundamentally shifting, I think the rate and speed at which it's shifting is increasing as well. Like, it's funny to think 4 years ago, such a long time ago, but now it's even I'd even say on a monthly basis, we can see the increase of what I've said a few times is like the mobilization of Australia's investment demand. Very similar to what you're saying. If you're talking in year 2000, the investment demand of that area would be your local business owners, your mums and dads that might have paid off their house that want to get another one. It's a very kind of localized market, which meant that it behaved in a certain way in accordance with those local drivers. Whereas over the last 4 years, from the time where we were ringing people up they'd never heard of a buyer's agent through to now, where you're looking at potentially a point where the entire country's investment demand can be mobilized anywhere because of access to tech, access to data, all these things we're talking about, it causes a fundamental shift in how these areas behave because you're no longer relying solely on that local investment demand. You're looking at an investment demand from what could potentially get to the point where it's the whole country. And the way we see that changing is the same way, the adoption of tech has happened. Like it's a slow start, and now all of a sudden we've got this exponential uptake in people taking advantage of that access to data, access to information, ability to transact in other areas. And that's causing, some pretty interesting patterns.
It's really interesting what you said there, Sean. Goose, a couple of minutes ago, you mentioned like how different property investing was 10, 15, 20 years ago. And back then, people were very geographically restricted because they didn't have access to data. And so they had to invest in areas that they knew, which were normally the suburbs around where they lived, where they could do their due diligence. They'd know everything. They'd know all sorts of information. And now we have access to data, not just all of the different suburbs in Australia through things like realestate.com.au, and then you've got CoreLogic. You have all of this data around. As you start looking into the data, suddenly you get a totally different picture of where the opportunities are. And it can be often the case that that conventional wisdom that people had 20 years ago, it's not just, that's not as effective anymore. That might not even work. And that can put you way behind where you need to be.
So I actually think a little bit differently to that. So I agree with you. I agree with you, by the way, right? So the old rules of thumb don't apply. Like and they haven't applied for years, right? And people still applying those rules of thumbs. Like, so for example, I knew a guy who his whole strategy, because he didn't have access to data and information, was buy within 10 or 20 kilometres. I think it was within 20 kilometres of a major CBD, so basically Sydney, Melbourne, and buy blocks that you could do a splitter, like so you could split and then subdivide and build two properties on. That worked awesomely until it didn't, because it wasn't actually a strategy, right? Like it was a tactic that would only apply under certain market conditions. A little kind of different take on sort of what you were sort of pointing to, though, was also how investors need to think about market entry points in the current environment as well. So now, don't get me wrong, if you could identify a suburb that was going to grow by 300% and it had grown by 0% for the last 5 years, and then you could enter in that suburb at the exact moment before it grew by 300%, of course, that would be ideal. But if you knew that a market was going to grow by 300%, and then if you could see that it had already grown by 50% or 100%, is that still a good place to buy, right? And I think that this is actually something that investors need to start changing in their mindset around how they need to think about location selection, because it's not just about can I find the spot that nobody else has been before me. It's actually about taking the time to do fundamental analysis to work out where do we think that this is going to go and why. Now, we use a combination of fundamental analysis and data science, right? So we don't solely rely on our technology. Allow me the opportunity to just sidestep for a moment. Residential real estate is the single largest asset class in the entire world. The single largest asset class in the entire world. It is also by far the least understood. In Australia, the residential real estate market, as of August, was $10.9 trillion. The entire market cap of all of the companies on the ASX is $2.6 trillion, which means that the Australian residential real estate market is 4.2 times larger than the entire ASX, right? Yet it suffers from a lack of understanding, right? And this is actually kind of like the biggest, this is why it becomes this kind of like, chicken bones and tea leaves kind of conversation around like, I reckon that this is where we're going to go. And, it's like, if the wind blows on my left side while the moon is at half moon, then I should buy in Sydney. It's like, it's bizarre logic that applies in this kind of scenario. So because of that, we have had to, over the last 5 years, invent entirely new technologies that don't exist anywhere in the world to try and solve for that market problem of a lack of understanding. It's the single largest, most valuable asset class in Australia, and we've had to solve for that. I know you want to say something, Emil, but let me riff on this for a second, because that is all well and good, and the technology is good, right? And the insights that we can get from the technology is good, but they don't beat fundamental analysis. Now, the king of fundamental analysis is Warren Buffett. He's the greatest value investor of all time. There are other investors that have beaten Warren Buffett. So he's not the best investor of all time. He's the best value investor of all time. Now, I want to use an example of Warren Buffett in this scenario because I think it's very, very, very important, and it points to how you can still use fundamental analysis, even to identify opportunities that are still growing. So Apple, iPhones, the MacBooks, all that kind of stuff. Apple, the company, went public in 1980. The iPhone was released in 2007, right? And we could probably all agree that was probably the major inflection point for Apple as it started to become a huge mass consumer adopted brand. Warren Buffett didn't buy Apple stock until 2016, and then it became the highest performing stock in his portfolio. It became one of the best investments he ever made. And he didn't buy it until 2016, and it went public in 1980. And by the way, it had already grown 115,000% before Warren Buffett bought Apple stock. So he didn't buy Apple stock when it was a penny stock, and he didn't buy it at the IPO or whatever. It had grown for 36 years. It had grown by 115,000%. But he did fundamental analysis on it, understood why it was able to continue to grow and where it was going to go next, and thus was able to make an investment very late in the piece, and that's still become one of the best investments he ever made. And so the issue that we need to consider here, particularly with the points that I referred to earlier, and there being many markets which are, subject to a kind of a perpetual bid scenario because we have so much force underneath the market pushing it up. It's not so much about trying to find where is this one spot that I can get in that nobody else knows about, and let me get in there first. It's actually taking the time to go, okay, based on the current set of circumstances, the current environment, the current macroeconomics, where are going to be the best places to put my money? And it's really going to come down to jobs, lifestyle, and affordability. That hasn't changed. That is, when I say affordability, I mean relative local affordability. Those things haven't changed. And so if you've got a location that has had some growth, but it still is primed for more growth, it still has lots of opportunity, good local affordability, great lifestyle, strong demand, and there's no reason for that to slow down and change, does that mean that you shouldn't invest there? Does that mean that you're going to go and specifically choose some other place that hasn't grown rather than investing in a place that has grown that potentially has better prospects? And I think that there's a big shift that investors need to make in their own mindset. Otherwise, they risk missing out on really, really strong opportunities.
I think that's a really important point. Like, so many people have this idea that buy the dip, right? Whether it's stocks, it's gold, it's crypto, it's property, or anything like that, buy the dip. Always buy the dip, buy low, sell high, right? Seems logical, seems to work. It's looked after people for a very long time if they just had the intel to identify where the dip is. But in my conversations with Sean, and we look at the way the entire Australian property market has all moved up, there isn't any dip, right? There's no dip to buy, right? These sort of flat suburbs, they're incredibly rare, and if they are flat, if they've been flat for the last several years, there's probably a reason, or there may be a reason, but you have to find out.
I don't want to. Yeah, I mean, let me rebut that a little bit as well, because I think it requires nuance. Like all of this requires a little bit of nuance. And Sean, I know I'm not getting you a word to get in edgeways. There is no hard and fast rule. You may find a suburb that has been flat for the last 5 years. That in and of itself, the fact that it's been flat for the last 5 years, doesn't tell you anything. That doesn't tell you that it's a good time to buy. It doesn't tell you that it's a bad time to buy. It doesn't tell you, there must be a reason it's been flat for the last 5 years, therefore I won't buy there. It also doesn't mean, look, it's been flat for the last 5 years, let's fucking buy there. It's not that simple. what you need to do is you need to have the capability to do fundamental analysis on a suburb. You actually need to know how to do that, which is actually pretty hard. And in order to do that well, you actually need advanced tools so you can get the insights you need. So the way that we think about layering up our approach is we use all of the technology we've invented and the data science to give us better insights to be able to do better quality fundamental analysis. That's effectively how the cycle works. So what that can mean is that there are locations that haven't grown as much or potentially at all, and there are even some suburbs which have gone down in value over the last, say, 3 to 5 years, right? That would be true. Now, some of those may represent an opportunity. And Sean, I know that you were looking at some recently, and we won't talk about where they are, but you were like, hey, these ones look like they're going to go in the direction we want to go, and also look like they've done basically nothing for the last few years. This could be an opportunity. So doing fundamental analysis is having the ability to discern what is good value and is going to take you in the direction you want to go. Now, sometimes that will mean that a market has just crashed and it shouldn't have, right? So, for example, and you can apply this to stocks or crypto or whatever, right? Potentially, there's a market which has got rock solid fundamentals, but then for some bizarre reason has had a collapse in its price, which isn't representative of the true value nature of the area. That could be an awesome opportunity. That'd be a buy the dip opportunity. Or you could have somewhere that has been stagnant and then is on the precipice of change because a number of dynamics are coming together to converge at a certain point to cause that location or that suburb to start to move strongly in an upwards direction. And sometimes you can have a location which has already been growing, but you're like, okay, there is nothing that's going to stop this train. This is going to keep growing for another 3, 5. Like we can't see anything in the distance that's going to stop this train. And they're all good reasons to consider to think about buying in that location.
Speaking of the reasons, this is in prep for this episode, I said to Sean, one of the questions I was going to ask is how does Dashdot continue to identify investment opportunities in areas that have already seen growth? And Sean said, that's not the right question, right? So do you want to explain what you mean by that, Sean?
It's always a principles-based approach. So I think if you took one message from this podcast, it's that the historical movement of MSP, median sales price, I've got a curse of speaking in acronyms all the time. The historical movement of the price in the suburb should not be your be-all and end-all of when you get in and out of suburbs. That's the main message we're having here. If it's gone up, gone down, gone sideways, that's not the number one thing we look at in identifying a good value investment. There's a number of other things that can be ranked miles ahead of that. So essentially, what we're looking at is principles, not just, hey, has it gone down? Has it gone sideways? Has it gone up? Past performance is never an accurate representation of future performance, which the big point in this, again, is COVID, which was a big macroeconomic unifying factor which moved all the markets up. So if you're thinking of it, pre-COVID, all these individual markets had their cycles. So let's just say there was a market at the perfect point in its cycle. COVID happened, which gave it a big boost. Does that mean it's no longer in the perfect point in its cycle from its intrinsic local drivers? No, it's probably going to keep going forward because all those values are still there. If there was a market that was tailing off and not in a great point in its cycle, yes, it might have got a COVID boost. And now we've seen it go back to the intrinsic drivers of that suburb and start to tail off, which means that might not be a good point in the cycle to invest. So although COVID has caused a lot of these markets to move in certain ways, it doesn't take away from what the local drivers that have put it to different points in the cycle pre-COVID.
100% agree. 100% agree. I think it's such a good point. Like people hear that statement, past performance is not a good indicator, a reliable indicator of future performance. And what they think about that is they think about, okay, that's a statement that someone would make when something's gone well, but they're trying to protect themselves if it doesn't go well in the future. But it also can mean like it's grown a lot in the past and it's going to grow a lot in the future. It can also mean it hasn't grown in the past and it's going to grow a lot in the future. Like
it means what
the statement works both ways. It just literally means that price is not the accurate metric to look at when trying to discern investable value in a location.
It's not in the top 10, you'd say.
Yes, it's not at all.
It's important because you have cash and you have a budget, but that's about it. After that, it's not an indicator of the growth, right? So
the
we're
trend,
not saying
the trend is not something
disregard
that's
price,
important.
right? You don't want to be overpaying for what you should be paying in a particular area, but you shouldn't be using it as an indicator of future growth.
Totally, yeah. And Sean just said, the trend. Like, so what we're talking about there is we're talking about the median sales price trend. Now, absolutely, price is a great factor in buying. You don't want to overpay for a property. And also, what you can identify from price is sometimes you can find that the price is asymmetrically below where the true market value is, right? And that represents an opportunity. So price is important to understand, but it shouldn't be driving. It's not a decision driver in terms of like the price trend. If the trend's going up, that means don't buy. Or if the trend's going down, that means don't buy. It's like, no. What are the fundamentals? Like on what basis are we making decisions around the future performance of the location? That's going to give you a better indication.
All right. Well, on that then, Sean, what are the key things that we do look at then? If price is in the dustbin.
There's a huge,
Don't tell them about the chicken bones and tea leaves.
Yeah, that's the only thing I use is my crystal ball. No, it's a really good example. Like back to the Warren Buffett example on value investing. It's a great example. If we've seen a lot of these local fundamentals in an area that are incredibly strong, yet the prices have gone down a little bit over the last 6-12 months. That is literally the example of which Warren Buffett would enter a stock. It's good value-based investing. So there's a huge number of things we look at. I know I've talked about local relative affordability an awful lot of times, but that's one big piece which people have to consider in this new real estate market. So I've said before, about 30% of the total dwellings in Australia are investment owned, 70% are owner occupied. So you can see the shift there where if 30% is what's driving all the growth in an area, and you haven't assessed the backbone and the fundamentals of that area, whether that can continue to support that growth, that's the situation where you can get into some nasty, I won't say the bubble word, Emil, I know you don't like that, but that's where you can get into some nasty situations where the fundamental values aren't there.
Well, what you see, like a typical market dynamic framework is that you can enter into a scenario where you end up with what's called the winner's curse, right? And that's when a market becomes over exuberant. And you can typically see that in the data. And that's also when we know to get out of a suburb, right? Because just because it's going up, and it could be going up really fast, right? And that's when people get excited. Oh, we've got to buy there, we've got to buy there. You know, like a significant number of property investors actually lose money in real estate in real terms because they buy in that kind of last piece of a price rise cycle where they're like, oh my God, this thing's been going up for the last however long. Purely on the basis of the price trend, they say, "Oh, this thing's going to the moon," and then they go and buy a property in there right before the market has a pullback because it has extended its price beyond the fair market value, right? Beyond the fundamental value in that location, and that's where you can get yourself into trouble.
This is what people are scared of at the moment, I think, because they see, you know, if a suburb comes up and we're looking at it and we're thinking, this looks like it's got plenty of potential growth, this is looking really good, it's passed all of our rigorous criteria, the AI, where we're spending millions of dollars every year to make sure that it's punching out reliable data and reliable sort of indicators, then people are thinking, well, no, but it's had a whole lot of growth. I'm buying at the peak instead of at the trough. I'm buying at the top of the market. That is a fear that people may well have because COVID has been a sort of macro unifying factor, as Sean said, and that's bumped all of the prices up. So now people are looking at graphs or data and thinking, oh, yeah, I've got access to all of this data. That the price has gone up. How much more heat is there in the market in that particular area? And unless you have really, really good data and you understand the fundamentals, like you've been talking about, then I can understand why people are scared. I also understand why they shouldn't be scared. Because if you look at the data and if you can analyze it properly, then it sort of takes away that fear, right? Knowledge generally gets rid of that.
Yeah, and we've never seen more of that winner's curse type of effect happening now with the mobilization of investment demand. So you can see these places where realestate.com says this is the new hotspot and it's going nuts, and you can see the price trend going through the roof. Those people don't understand what is driving that growth. So just to throw people a couple of bones, like things you can look at is like you can get data on what sort of loans are being written, how many investment loans are being written in an area versus owner-occupied loans. Things like inquiry levels from places that are that are, realestate.com, domain places like that, are all the inquiries coming from interstate investors, local owner occupiers, things like that. So you can start to see that the median sales price growth, although if it's trending up, if that's being driven by certain things, it doesn't necessarily mean that that's the best place to jump into.
Yeah, it really comes down to the fundamental analysis. I mean, even if you look at like the technology that we've developed, right? Let's say the price and rent forecasting models that we've developed that we won awards for. There's some scenario. Just that. Let's just talk about that piece of technology for a moment. Sometimes that says this place is going to go up and to the right. But we then do fundamental analysis and we say, you know what, that's one data point, but let's look at all of the other stuff and let's decide whether or not we actually have an opposing opinion to it. And sometimes we do, and that's actually a really important part of it. So sometimes even with all of our technology, we'll have certain parts of our technology, like maybe our predictive model, we'll be like, oh, this location looks like it's going to be flat. But then we look at everything else and we go, no, it's not. Right. And so having that ability to kind of weed through that is really the most important thing.
I think that's unique to us. The level of data that we're able to get. I had an episode with Julian a little while ago, and he went through all of the number crunching and where we get the data from and how reliable the data is. Like, we're talking top-notch data sources, and then we crunch them and we get really, really reliable output that says, this suburb looks like it's a great suburb, etc. But then the level of human checks that happen after that, right? It goes to the property team. You get vetted. We're calling agents on the ground in that particular suburb. We're collecting a whole lot more information about property availability in those areas because an AI model is it's getting data from the past, right?
It's good, right? But we're not making decisions based on that, right? And this is what's important, right? Because you can go onto a website and get some property data. Cool. But if you don't know what to do with it, if you don't know how to actually use that, it's useless. It's completely useless, probably counterproductive because what you'll actually do is you'll think you're informed, but you've got no idea what you're doing, and then you could go and make the wrong decision. And I think it's really worth zooming out and actually thinking about how this kind of like how to find asymmetry, like finding asymmetry and finding those undervalued opportunities is actually really the key to getting all the success you want. That's actually really, really the thing. Now, undervalued, again, I'll re-emphasize this. Just because a location has grown, and even if it's grown for 2 or 3 years, doesn't mean that it's overvalued or doesn't mean that it's at its peak. That doesn't mean basically anything. And people have got these really short time horizons as well, right? Everyone, human beings just naturally just have these really short brains that we can't think, okay, if this place has grown for the last 2 or 3 years, that means, oh, well, it's going to be all over. But if it's going to grow for another 4 years and you're going to triple your money over that period of time, is that still a good investment? Probably, right? So, but the other thing to zoom out and think about is thinking about the strategic approach. Like, what are we trying to achieve? Because what we've noticed as well is looking beyond residential houses, for example. Because one of the things that has changed specifically in the market over the last couple of years, particularly, is affordability. Now, we talk about relative local affordability all the time, but that is only one of the 3 core drivers that really drive any location, which is lifestyle, jobs, and relative local affordability. Now, they're 3 very simplified headline topics that we can look at, which each have a waterfall, a cascade of data points and references that we need to establish and understand in order to validate any single one of those. It's not as simple as going, well, it's got a nice park, so lifestyle, tick. It's how do we define that? We've had to invent entirely new metrics to try and categorize these particular components to be able to make sense of it. But when you start to then look at how the macroeconomic environment has changed, and anyone who's listened to me on the podcast recently knows that I'm deep in the macro end of the pool, because what I've discovered is actually probably the biggest driver of things that are going on at the moment. You then start to go, okay, so is there a location which may meet the criteria of jobs and may meet the criteria of lifestyle, which has subjectivity to it and needs to be measured in a very specific way, but houses don't meet the relative local affordability criteria, but units do. Now, that's interesting. Because now you've potentially found an opportunity, going back to your point earlier, where people operate on these rules of thumb, where they're like, oh, you got to buy within 20 kilometers of a CBD. You don't. Got to buy properties that are north facing.
Biggest block possible. That's another good one.
Yeah, exactly. You've got to have a certain block size. Probably doesn't matter. Must be able to see the ocean. Probably doesn't matter. Like, there's all these kind of things, including, and by the way, I'll be the first person to admit that this was a point of view that we held up until recently, too. That units can't perform as well as houses. Now, to be fair, we've never held dogmatically onto any single point of view, because the way we've approached all of this is from a basis of science. What I love about science is never true. Science never pretends to be true. No, science never says this is the absolute truth. It says this is the best we can know right now with the information we have, but it's only the best that we know until we can prove it wrong. It should always be seeking to prove it wrong. And that's what science fundamentally is, right? And so we've taken that approach to property investing from day one. And what we've discovered, particularly recently, is that there is an asymmetric opportunity in units, and that's where we could derive a lot of value out of that. And understanding how to change the thinking to support that is critically important. Otherwise, you could be leaving huge amounts of opportunity on the table. There's investors who, stock market investors who don't understand technology, therefore only invest in profitable companies that have been operating for more than 50 years or commodities or whatever. And as a result, they've underperformed the market radically over the last little. I mean, look at Ray Dalio. Ray Dalio, one of the greatest investors of all time, Bridgewater Associates is his hedge fund, it was the largest hedge fund in the world. I think it's now not the largest hedge fund in the world, because $70 billion of investor capital has left because he's underperformed the market by so much over the last 10 years that people are like, I can't even afford to keep my money in here because I'm losing all my money. That's because his ideas haven't changed. He formed a set of ideas and he said, these are the rules. But the rules need to change as the market changes. And if you don't do that, then you're going to be left out and left behind. And necessarily that means that you need to retain an open mind that is willing to challenging your own internal beliefs and being open to new ideas. I think that the more investors can understand that, stay nimble, stay limber, stay open to exploring, why might these things work and why might a specific point of view be worthwhile considering, I think is actually going to set them up for a greater level of success and help them avoid these internal biases and all of this kind of stuff, which might get them out of good opportunities. Let me actually just, sorry to hog the microphone a little bit, but there's a specific example. I could probably list 50 or more examples just like this, and I'll give you a couple. So a few years ago, when we very first started investing in Armidale in Western Australia, which everyone thought was, excuse my language, a shithole, and we were convinced that it was going to be one of the best performing suburbs over the next couple of years. We had clients who said, no, we're not going to buy there. And in fact, discontinued our services because they said, we're definitely not going to buy there. Now, those clients, and there's something I know of specifically, ended up not buying any properties. And that suburb ended up being one of the best performing suburbs in the country. Another client we had several years ago, I suggested that we buy in the Hunter region, specifically in Muswellbrook. And he said, nah, I'm not going to do that. I know all about that area. I'm not going to fall for that trap sort of thing. And then again, chose not to invest in that area. And he chose to invest somewhere else, which had suboptimal growth, below market performance growth. And over that period of time, Muswellbrook was one of the best performing suburbs. And so what can happen is that people can create misinformed opinions, and as a result can leave a lot of opportunity on the table. Now, the whole reason that you invest, the whole entire reason that you invest is because you need to get your capital to work harder for you than you can work for it, so that you can create an opportunity for you to not have to continue to work until the day you die. Now, I just see time and time again, people who lack the expertise to make a good decision, then going against good advice, and as a result, either making no decision or making poor decisions, and then getting left behind. And I think that's actually the biggest problem we need to try and tackle.
I definitely agree, and I could have numerous examples of that as well. But I think you've said many times before, strong beliefs held loosely is really, really critical when it comes to investing, because it's always on a principles-based approach. I know I've done some wild examples in the past on this podcast as well, with dance studios in Humpty Doo and whatever else. But it's the same thing again. I wouldn't go out and buy penthouse apartments off the plan in high rise. That's probably the most triggering asset type I can think of on the spot. But if you found one of those that you could justify was 400,000 under market value and a 10% yield and had all these other things that were stacked up for it on a principles based approach, that's a good investment for somebody somewhere in their portfolio. But if you said, I want 1,000 square meters and quarter acre dream and I've got to be here and there, you might miss out on opportunities like that. Now, I'm not saying there's a great deal of $400,000 under market value penthouses getting around, but it's a good example to, like, strong beliefs held loosely, I think, is critical, and more critical now than ever, as strategies and tactics are cycling so quickly, because the rate of change in the market is not only quick, but it's getting quicker, that you have to constantly be nimble and be willing to take on advice and willing to learn and break down those kind of preconceived ideas that might have worked 10, 15, even 2 years ago, that may not be relevant anymore.
I think you touched on a really interesting point there about how the speed of change is increasing, and this is something that doesn't actually get spoken about enough. Because just the nature of the world that we live in is actually running on exponents, and human beings have a fundamental inability to truly understand exponentials. And if we look at how much changed if we look to say from 1950 to 1970, how much changed in property investing in Australia, the answer would probably be really not much. If you look from 1970 to 1990, the answer would probably be, not much. If you look from 1990 to 2010, you'd probably say, okay, actually, noticeably different, right? Okay, that's interesting and noticeably different. If you look at 2010 to 2020, you'd be like, okay, there's a lot of change happening there. Look at 2020 to now, it's a different sport. It's a different sport.
1,000 times the amount of change, I would say, than the history of Australian real estate prior. Like, it is moving so incredibly quickly that it's hard to actually conceptualize and understand the rate at which it's changing.
And this is why from day one we always took an approach where we're not going to be dogmatically, attached to a specific idea. So for example, when we very first started, renovating for profit. It's a great idea. It's a great idea. And you can make a bunch of money doing that. It's dollar for dollar. One of the best things you can do. You're doing a cosmetic renovation. You can make $2 for every dollar you put into it, and that's a fundamentally good idea. Now, we could have built our entire business around we're going to find properties that need renovations. But the problem is that puts you very, very squarely in a box. And you can make money doing it, but it's not the whole answer. It could be an answer to a question, but it's not the whole answer to the whole question.
Yeah, at a certain time too. That's the key
time,
thing.
In a certain way, in a certain market, based on certain conditions, that can work. And just like the example I gave earlier about the guy who was buying in capital cities and doing splitter subdivisions, that can work. It can be a good idea at a certain time, in a certain way, at a certain point in your portfolio. But it's not the whole. It's not the whole picture. To get the whole picture, you need to zoom out. And you need to say, what are we trying to achieve? What are all of the opportunities that exist in order to get me from where I want to be right now from where I am right now to where I want to be? Then how do we deftly maneuver through all of these changes and surf the changes rather than swim against the tides? That's the thing that people need to start to get their head around.
This is what I think is absolutely key, is that Dashdot is not a reno company. It's not a house and land company. It's not positive cash flow only. It's not sort of blue chip suburbs. It's what is the strategy that is going to work in the market.
We're a freedom company.
For you personally, I think is a key thing as well, because there is a place for every style, tactic, asset, all these different things for somebody at some point in their portfolio. So it's not only just, and that's one big mistake I see a lot of people making, is there's, like you said, these companies that are like, this is the tactic. What if that is a complete mismatch for that individual's set of circumstances? It may work, but what are you trying to do as a cash flow play that somebody's really, capital poor and needs to build that side of their portfolio? Like there's all these individual circumstances which can also come into play in prescribing what that individual tactic or property or asset needs to be to get you to your goals as fast as possible with the least amount of risk.
So we're not a silver bullet company. We're an optimization company.
Optimizing
people's freedom.
I've always thought about ourselves as a freedom company. Like it just happens that property is the vehicle that we're able to affect the most amount of positive change in people's lives, right? So I've never really, and I've tried to keep that in front of mind, because the goal isn't how many properties can you buy. The goal isn't really anything. I could list 100 things that it's not, and one thing that it is. The one thing that it is how to help people create the freedom, choice, and abundance in their life that they want and deserve. That's really that's the only thing that matters. That is the single only thing that matters. It doesn't matter whether the house is blue. It doesn't matter whether the roof is upside down. It doesn't matter whether it's a unit. It doesn't matter whether it's a dance studio. None of that matters. The only thing that matters is how to create the life that you deserve. And how do you do it in the fastest way with the least amount of risk? And the way you do that is you do that with an adaptive strategy that can suit the market and find the best opportunities. That's how you do it. And if you just keep focused on the goal, let everything else work itself out. That's what I would say.
Well, that sounds like a very good note at which to wrap up the podcast. I think that's a very nice coda to everything that we've talked about so far. Anyone have anything that they want to, any last thoughts?
I don't think I'm going to top that.
Wrapped it up.
I wholeheartedly agree.
Absolutely. All right. Well, thank you very much, everyone, for listening. Thanks, Sean. Thanks, Goose, for jumping on. And we'll hope to see everyone again in another episode next week.
Cool. See you soon.
Cheers.
Bye.
Bye.